The Schwab US Dividend Equity ETF, better known by its ticker symbol of SCHD, is one of the most popular dividend ETFs on the planet. But if you're holding it right now, you may want to pay very close attention to this video because something big just happened and it could spell serious trouble for SCHD and your retirement portfolio. President Trump's latest move in the trade war has thrown markets into chaos, and while some investors are buying the dip, I'm here to explain why SCHD might not be the safe and defensive dividend ETF everyone thinks it is, and perhaps what you can buy instead to do even better. Before I get into this video though, if you're serious about dividend investing and protecting your wealth, stick around to the end. And if you appreciate deep dive and analysis into dividend investing content, whether it be ETFs or individual stocks or simply strategies and philosophies, smash that like button, subscribe to my channel, and turn on the notifications button. Now let's get into the video. SCHD has rapidly grown in popularity with assets under management exploding over the years. And there's good reason for this. It's delivered strong total returns while paying out consistently high and growing dividends. In fact, it's grown its dividend at about an 11% CAGR over the past decade. With a low expense ratio of just 0.06% and over 100 blue chip dividend stocks in its portfolio, well diversified across a number of sectors, it's become a favorite among dividend growth investors, and again, for good reason. However, recent developments have somewhat changed the game for SCHD. In particular, President Trump announced massive new tariffs. 10% on most U.S. trade partners for 90 days, over 100% tariff on Chinese imports. And while markets have bounced back somewhat, there are still significant headwinds facing the economy, including the average U.S. tariff rate is still estimated to be over 20%, and global supply chains are being disrupted, and international companies are on edge. Now, why is SCHD particularly at risk? Well, unlike the S&P 500, SCHD is heavily invested in physical goods producers. And these goods are easy targets for tariffs, boycotts, and supply chain issues. While software companies like Meta and Microsoft can probably ride out tariffs better, many of SCHD's holdings probably will not be able to. Now, there are some that should hold up pretty well. For example, Verizon has been highlighted by billionaire investor Bill Gross as a potential winner. And that's because it's domestic focused, and again, it's a service provider, so it shouldn't suffer too much. However, there are other companies like Coca-Cola and Pepsi which may be boycotted overseas by people who are anti-US, very least will likely face some major supply chain headwinds and potentially some tariff impacts on its margins. They're relatively low switching costs. Yes, people like Coca-Cola and Pepsi drinks, but they're often knockoff brands that are cheaper, local brands in different countries or even in the US. People feeling the pinch, they may switch to generic brands. And they are heavily exposed, again, like I said, to global supply chains. Then you have the likes of Chevron and ConocoPhillips, which almost 20% of SCHD's portfolio is made up of energy now during its recent reconstruction. And so those kind of companies are going to get hit because crude oil prices have plunged, which will probably hurt their profit margins considerably. And so those commodity-based earnings are going to be more volatile. Then you have biotech and healthcare companies like Amgen and Bristol Myers, which are major components of SCHD as well, that are heavily reliant on global supply chains. They face political pressure as well to reshore manufacturing to the U.S., and that's going to likely hit their profit margins as well. And you have the Home Depot, which imports a lot of its goods, and so its costs may suffer from tariffs. Now, yes, a recession may also hurt home renovation spending, although Home Depot is somewhat of a defensive company as well because it does sell a lot of essential items for home keeping industry, and people are more likely to invest in their homes and other things, and so oftentimes spending on their homes is something that people pull back last after other cuts in spending. And there's Lockheed Martin, which in a way is positioned to benefit from the current environment because geopolitical tensions are soaring and demand for military products is increasing. But at the same time, you have allies canceling deals. You have President Trump hinting at toned down exported jets potentially for some allies, and the European Union, for example, is ramping up its own defense sector. And so those are some reasons potentially that Lockheed Martin could suffer some headwinds. And so, some people think that the S&P 500 may be a safer bet because of, again, software plays, less consumer goods. But even then, the S&P 500 faces a lot of risk too because it has heavy exposure to Apple, to Amazon, to Tesla, to NVIDIA, and these are all very China-sensitive companies that are likely getting disrupted significantly in the current trade war environment. Additionally, the S&P 500 is very expensive still. And so while it may have some strengths relative to SCHD, I don't think the S&P 500 is a place you want to turn to either. In fact, I think overall SCHD is a better option than the S&P 500 because overall it's more defensive. It's significantly more attractively valued right now, and its dividend yield is likely to be stable and continue growing over time. And so that gives a ballast of certainty, especially for retirees in the midst of a trade war. And even for people focused on total returns, I think SCHD has a lot going for it from a valuation perspective. But ultimately, I don't really like either of these options too much. Instead, I'm buying my own individual stocks. And here's why: because I can buy businesses that are durable and defensive, that have less tariff exposure and are paying even higher yields and still trade at very attractive valuations. Companies like midstream infrastructure, so whether that be Enterprise Products Partners, Energy Transfer, MPLX. You could also go with the C Corp route with Western Midstream, Kinder Morgan, Enbridge, TC Energy, etc. Or you can just buy broadly diversified ETFs in the space like the Illyrian MLP ETF or the Global X Energy Infrastructure Fund, or others like them that have relatively reasonable expense ratios and give you that nice yield and diversification. And again, that's because they're domestic infrastructure companies. They're not heavily exposed to commodity price risk. They're not directly impacted by trade wars. They have inflation-linked contracts. Then you have real estate investment trusts, or REITs, that are also great because they're almost entirely U.S. focused. They have defensive cash flows from their long-term leases. They trade for pennies on the dollar valuation relative to their private market values. They pay attractive dividends. They have pretty strong balance sheets. They're fairly defensive and durable. Again, not really impacted by tariffs too much. So like picks like Realty Income, for example, Mid-America Apartment Communities, Camden Properties Trust, Rainier, which is a 100% U.S. focused, Woodlands, Timberlands REIT, that's another great option. So many good options out there. And so if you think the trade war will be short-lived, maybe SCHD is a great buy the dip opportunity. And overall, I think SCHD is a fine pick, even if you think it's going to be long-term. But I don't think it's nearly as compelling as an opportunity as some may think, especially because of its recent reconstitution to include more energy companies in it. And so instead, I think that a better opportunity is to be buying individual dividend stocks right now. And that way you can create a actively managed part of your portfolio, you get an even higher yield than SCHD, pays out a very strong dividend growth rate similar to SCHD, and have much lower long-term risk exposure to the trade war if it does persist for the long term. So with that, if you enjoyed this video, let me know in the comments. Are you still buying SCHD right now? Are you still buying the S&P 500? Or are you making changes, and are you focusing more on individual stocks or simply even just ETFs in more defensive sectors like midstream infrastructure, utilities, and REITs? Let me know, and be sure to like the video, subscribe to my channel for future content like this, click the notifications button, and again, let me know in the comment section below what you're buying in this environment. Thank you very much. See you next time.